I need to show you something that happened in the last 20 hours that changes the entire tactical landscape for precious metals. Not in a theoretical way, not in a maybe it matters 6 months from now way, in an immediate, documented, quantifiable way that connects directly to why silver just moved $5 in a session and why the structural case for precious metals as war insurance just became the most urgent trade thesis in global markets. February 18th, 2026. Axios publishes a report citing evidence that U.S. war with Iran is imminent, and Israel is preparing for a scenario of war within days, not weeks. Days. The report specifies that this would be a weeks-long full-fledged war, not a limited strike like the June 2025 operation. The Kobesi letter, one of the most closely watched independent financial analysts on the platform, confirms the report and adds specific numbers. 2 aircraft carriers, 12 warships, hundreds of fighter jets. Multiple air defense systems, more than 150 cargo flights transporting weapons and ammunition already completed. Oil surged above $64 per barrel within hours of the news breaking. Silver, which had been consolidating near its recent lows, jumped immediately. Gold made a record weekly close. And every mainstream financial outlet that spent the last 3 weeks telling you the precious metals bull market was finished went silent. Let me be precise about what the timeline looks like right now, based on multiple independently verified sources published in the last 48 hours. Bob McNally, founder of Rapidan Energy Group and former White House energy advisor, told CNBC on Thursday that he would put 75% odds that in the coming days to weeks there will be some sort of U.S. attack on Iran. 75%. That is not a casual hedge. That is a professional energy analyst with direct access to administration decision-making saying the probability is 3 out of 4 that strikes happen imminently. President Trump told NBC News directly that Iran's supreme leader Ayatollah Ali Khamenei should be very worried, adding that, as you know, they are negotiating with us. The phrase negotiating with us in the present tense, combined with the threat, means talks are still active, but the military option is being openly prepared as the alternative if negotiations fail. Trump previously threatened to intervene on the side of protesters who rose up against the Islamic Republic in January, but ultimately backed away from military action that time. This time, the military buildup is documented, public, and substantially larger than what was deployed in January. Here's what makes this categorically different from the speculation that circulates every few months about potential Middle East conflict. The scale and specificity of the deployment. 2 aircraft carriers, the USS Abraham Lincoln, and a second carrier strike group, 12 warships. That is not a deterrent posture. That is an offensive capability structure. Hundreds of fighter jets, now positioned in theater, multiple air defense systems covering the strike corridors that would be used if the operation proceeds. And more than 150 cargo flights that have already been completed transporting weapons and ammunition to forward operating bases. When you move that volume of ordnance by air rather than by sea, it signals urgency. Sea shipments are cheaper and more efficient for bulk cargo. Air transport is used when speed matters more than cost. The fact that the U.S. military has already completed more than 150 air cargo missions to pre-position ammunition and weapons in theater before any strike announcement means the operation is in final staging, not preliminary planning. The Axios report, which cites sources with direct access to intelligence assessments, describes the potential conflict as a weeks-long, full-fledged war, explicitly contrasting it with the Venezuela operation that resulted in the capture of Nicolas Maduro in January. That Venezuela mission was executed in days with minimal broader conflict. The language around Iran is weeks-long and full-fledged. Those descriptors matter. Weeks-long means this is not a surgical strike on nuclear facilities followed by immediate withdrawal. Full-fledged means this involves sustained air operations, potential ground force coordination with regional allies, and a campaign timeline measured in multiple weeks rather than multiple days. Israel is reportedly preparing for war within days. That phrasing, within days, is a timeline. Not within weeks. Not if diplomacy fails. Within days. That suggests Israeli intelligence has visibility into U.S. operational planning timelines and is positioning accordingly. Now let me show you what happened to markets the moment this news crystallized. Oil prices surged above $64 per barrel on WTI crude, the U.S. benchmark. Brent crude, the international benchmark, broke above $70 for the first time since August 2025. That is a multi-month high driven entirely by the geopolitical risk premium being repriced into energy markets. The Strait of Hormuz, through which approximately 20% of the world's oil supply passes, sits directly adjacent to Iranian territorial waters. Iran has previously threatened to close the strait if attacked. Whether they can successfully close it against U.S. and allied naval assets is debatable. The threat itself is credible enough that markets immediately price it in. A sustained closure or even partial disruption of traffic through Hormuz would remove millions of barrels per day from global supply. That does not just move oil prices, it moves them violently and persistently. Silver responded with one of its strongest single-session moves in weeks. The specific number varies depending on which session you measure, but multiple sources confirm silver jumped as the Iran news broke. Gold climbed above $5,000 and made a record weekly close in London. That weekly close is significant because it occurred after 3 weeks of correction narrative, 3 weeks of falling knife warnings, 3 weeks of speculative blow-off headlines, and the moment genuine war risk re-enters the pricing environment, gold makes a record close. That is not a market that agreed with the bearish repricing. That is a market that was waiting for a catalyst to resume the structural trend. Let me address the skepticism directly because I can already hear it. We have had Iran war speculation before. It never materializes. Markets overreact to every Middle East headline. This time might be the same. That skepticism is reasonable, and it deserves a data-driven response rather than a dismissal. The historical pattern of Iran conflict speculation is that it produces short-term volatility followed by mean reversion when the immediate crisis passes without escalation. The June 2025 U.S. strike on Iranian nuclear facilities fits that pattern. Limited operation, temporary oil price spike, return to baseline within weeks. The Venezuela operation in January 2026 also fits. Surgical mission, minimal market impact beyond the immediate session, normal conditions restored quickly. But there are 3 specific elements in the current setup that distinguish it from previous episodes of elevated rhetoric. First, the scale of the deployed military assets. 2 carriers, 12 warships, hundreds of jets, and more than 150 completed air cargo missions represent a force posture that exceeds what was deployed before the June 2025 strike and substantially exceeds what was in theater during the January Venezuela operation. When you position that much offensive capability, you are either preparing to use it or you are conducting the most expensive bluff in modern military history. Both are possible. Only one is consistent with the specificity and urgency of the reporting from sources with intelligence access. Second, the domestic political context. Trump has been publicly critical of the Iranian regime's violent crackdown on protesters. Tens of thousands of people have been killed since protests broke out in late December 2025, according to multiple human rights organizations. Trump warned the regime not to kill protesters and vowed help was on the way. That is a public commitment. If the regime continues killing protesters at scale and Trump does not act, it undermines his credibility on the issue he has chosen to publicly stake a position on. The political incentive to follow through is therefore materially higher than in previous speculative cycles where no such public commitment had been made. Third, the intelligence that China may be providing Iran with satellite imagery, navigation support, and real-time tracking of U.S. military movements. The Defense Journal reported this on February 18th based on sources that suggest China's Beidou navigation system is being made available to Iranian forces. If that reporting is accurate, it changes the strategic calculus. A U.S.-Iran conflict that China is providing intelligence support for is not a bilateral regional confrontation. It is a proxy engagement in a larger U.S.-China strategic competition. Markets price bilateral regional conflicts as temporary disruptions. They price U.S.-China proxy confrontations as structural geopolitical realignments with persistent effects on commodity flows, currency reserves, and safe haven demand. Now let me connect this directly to the silver thesis, because this is not a general geopolitical story. This is a structural silver story wearing geopolitical clothing. The COMEX delivery pressure that I covered in the previous analysis remains completely intact. Registered inventory drainage of 785,000 ounces per day has not stopped. February's 98% delivery rate has not reversed. March open interest representing 429 million ounces against approximately 85 million registered ounces has not resolved. All of that pressure is still building toward February 27th, first notice day, 11 days from today. War risk does not remove that pressure. War risk amplifies it. Here's the mechanism. Industrial users of silver, which represent the majority of global demand, hedge their procurement costs through COMEX futures. They buy futures contracts as insurance against spot price increases. When geopolitical risk suggests that supply disruptions are possible, industrial hedging accelerates. Manufacturers do not wait to see if war actually breaks out. They hedge the moment the probability rises above background noise. The 75% probability that Bob McNally cited is well above background noise. Samsung, Tesla, and other major technology manufacturers who have already shifted to direct mining supply agreements did so because they no longer trust COMEX to reliably deliver physical silver when needed. A war that threatens Persian Gulf shipping lanes and broader Middle East logistics makes every supply chain manager in every electronics, solar, electric vehicle, and defense manufacturing company immediately question whether their silver procurement is adequately secured. When those supply chain managers decide to increase their hedging or accelerate their physical purchases, they are not buying paper silver ETFs. They are standing for delivery. They are calling their contracts. They are demanding physical metal. That behavior is what produced the 98% delivery rate in February. That behavior is what drained 26% of COMEX registered inventory in January alone. And that behavior accelerates, not decelerates, when war risk enters the calculation. Every data point that suggested March delivery pressure was building before the Iran news is now operating in an environment where the incentive to secure physical silver early has materially increased. Silver's role as both an industrial commodity and a monetary metal becomes uniquely important in this scenario. Gold is a pure monetary metal. Its primary use case is wealth preservation and central bank reserves. When war risk rises, gold gets bid as insurance. That is straightforward and well understood. Silver has that same monetary insurance function, but it also has the industrial supply chain vulnerability that gold does not have. If Middle East conflict disrupts logistics, shipping insurance costs increase. Route alternatives become necessary. Transit times extend. Every one of those supply chain frictions makes procurement more expensive and less reliable. Manufacturers respond by increasing inventory buffers and accelerating orders. That is industrial demand layering on top of monetary safe haven demand. Gold only gets the safe haven bid. Silver gets both. The solar panel manufacturing sector is particularly exposed. China dominates global solar panel production. Silver is a critical input for solar photovoltaic cells. If U.S.-China tensions escalate through the Iran proxy dimension, the reliability of silver supply chains that run through Chinese refining and processing becomes a legitimate concern for Western manufacturers. Even if physical supply is not actually disrupted, the perceived risk of disruption is enough to drive hedging behavior that tightens physical markets. The Silver Institute has already confirmed that industrial demand for silver and solar reached 510 million ounces annually, with cumulative shortfalls projected to exceed 1.5 billion ounces by 2030. Those projections were made before the current Iran escalation. If manufacturers accelerate their procurement timelines even slightly in response to elevated supply chain risk, that demand curve steepens. Now let me address the oil angle because it directly affects silver through a mechanism most people are not tracking. Oil at $64 and climbing changes the economics of silver mining. Silver is energy intensive to extract and refine. When oil prices rise, mining costs rise. Marginal silver mines that were barely profitable at $50 oil become unprofitable at $70 oil unless silver prices rise proportionally. The Silver Institute projects mine production increasing by just 1% in 2026 to 820 million ounces. That 1% increase is based on cost structures that assumed relatively stable energy prices. If oil sustains above $70 for an extended period because of war or the credible threat of war, some percentage of that projected mine supply does not materialize because it becomes uneconomic to produce. Lower supply against unchanged or accelerating demand widens the structural deficit. The sixth consecutive year of supply deficit that the Silver Institute confirmed gets worse, not better, in a sustained high oil price environment. There is also a monetary policy dimension that the war risk reactivates. The Federal Reserve had been signaling a higher for longer rate posture based on the idea that inflation was moderating and the economy was resilient enough to handle restrictive policy. War risk changes that calculation immediately. If oil moves from $64 to $80 or $90 because of Strait of Hormuz disruption risk, headline inflation reaccelerates. The Fed's ability to hold rates high while inflation is climbing becomes politically and economically untenable. Markets are already pricing in increased odds of a rate cut in the second quarter. The January CPI print that came in soft at 2.4% was one of the factors driving that repricing. A war-driven oil spike that pushes headline inflation back above 3% forces the Fed into a policy response. Lower rates are structurally bullish for non-yielding assets like silver and gold. The war scenario that drives oil higher simultaneously creates the conditions that force the Fed to cut rates, which supports precious metals from the monetary policy side, even as the war itself supports them from the safe haven demand side. China's potential involvement introduces an additional layer. If China is providing intelligence and navigation support to Iran, as the Defense Journal reported, then a U.S. strike on Iran has the potential to escalate into a broader U.S.-China confrontation. China controls 60 to 70% of global refined silver production. China implemented silver export licensing requirements on January 1, 2026 that restrict overseas sales to large state-certified producers. If U.S.-China relations deteriorate because of the Iran proxy dimension, those export restrictions could tighten further. China has previously used rare earth export restrictions as a strategic tool during periods of trade tension. Dan Alamariu, chief geopolitical strategist at Alpine Macro, specifically warned that Beijing has already signaled it would respond if Trump follows through. One risk raised by analysts is the potential for China to again restrict exports of rare earths, although such a move is considered unlikely in the short term. If China can restrict rare earths, it can restrict silver. Silver export licensing already exists. Tightening it is an administrative decision, not a new policy creation. The leverage is already in place. Let me also address the dissenting view because it is being expressed loudly by credible voices and deserves acknowledgement. Mark Essien, a Nigerian tech entrepreneur, argued on Twitter that Trump starting a bombing campaign against Iran would break his understanding of how the administration works. It does not really make sense, Essien wrote. The US can obviously win, but then what? The next cadre of leaders is still variants of the same people. Essien warns that Iran's drone capabilities and potential insurgency could make the situation difficult to resolve quickly. That is a reasonable strategic skepticism. A military victory that leaves Iran's political structure fundamentally unchanged and creates a prolonged insurgency is not a win in any meaningful sense. The Afghanistan and Iraq experiences provide decades of evidence for why that outcome should give decision-makers pause. Marjorie Taylor Greene, former congresswoman, wrote that Americans do not want to go to war with Iran. They want to be able to afford their lives and get ahead. That is a political reality. Domestic opposition to another Middle East war is significant and bipartisan. The administration is aware of that opposition. The question is whether that opposition is sufficient to prevent action when the 75% probability that Bob McNally cited is based on his direct assessment of current administration decision-making. McNally is not a hawk. He is an energy analyst with decades of experience reading policy signals. If he is putting 75% odds on strikes within days to weeks, he is seeing something in the decision-making process that overrides the domestic political opposition. Markets are resolving this uncertainty by pricing in the war risk premium while leaving room for the scenario where diplomacy succeeds and the military option is not exercised. That is why oil moved sharply, but not catastrophically. $64 is elevated but not panic. $70 on Brent is a multi-month high but not a supply shock level. The pricing suggests markets believe there is substantial probability of conflict but not certainty. That pricing structure creates asymmetry. If diplomacy succeeds and the military option is taken off the table, oil gives back some of its recent gains but does not crash because underlying supply-demand fundamentals are relatively balanced. Silver gives back some of its geopolitical risk premium, but the COMEX delivery pressure, the structural deficit, and the industrial demand trajectory all remain in place as fundamental support. But if diplomacy fails and strikes proceed, the upside scenario for oil and silver is substantially larger than the downside scenario if diplomacy succeeds. Oil to $80 or $90 is realistic if Hormuz is threatened. Silver moving from current levels back toward $100 or higher is not speculative if industrial buyers panic hedge and COMEX delivery pressure intensifies simultaneously. The asymmetry favors holding exposure through the uncertainty rather than exiting to avoid volatility. This is the classic insurance trade structure. You pay a small premium for protection against a large downside. In this case, the premium is accepting some volatility. If the war scenario does not materialize, the protection is being positioned for a potentially massive move if it does. Here's what I am watching in the next 72 hours. First, oil price sustainability. If oil holds above $65 and continues climbing towards $70 on WTI, it signals that the market is pricing sustained war risk, not a temporary headline spike. Second, any official statements from U.S. or Israeli defense officials confirming or denying the within days timeline that Axios reported. If that timeline is walked back publicly, it reduces the immediacy of the threat and gives diplomacy more time. If it is not walked back, or if it is implicitly confirmed through continued force movements, the 75% probability Bob McNally cited becomes more credible. Third, Chinese official statements regarding their relationship with Iran, and specifically whether they confirm or deny providing intelligence support. If China denies it publicly, the bilateral regional conflict framing holds. If China does not deny it or offers ambiguous language, the proxy conflict framing strengthens. Fourth, silver's behavior in the Asian session. Shanghai is currently closed for Chinese New Year and does not reopen until February 23rd. But when it does reopen, watch whether the premium that Shanghai has historically maintained over COMEX reasserts immediately. If Shanghai reopens and the premium jumps back to $6 to $10 over COMEX spot, it confirms that Eastern physical buyers view current prices as too low and are willing to pay significantly more for real metal. That premium reassertion would be independent confirmation that the structural physical demand case for silver remains intact regardless of what the paper market does during the Shanghai closure. And fifth, February 27th, COMEX first notice day, which remains 11 days away. The war risk does not remove the delivery pressure, it layers on top of it. If longs stand for delivery at elevated rates similar to January and February, And if war risk simultaneously drives new hedging demand from industrial users, the March delivery period could produce the conditions that force either unprecedented conversions from eligible to registered, significant spot price increases to attract more metal into the registered category, or the deployment of cash settlement that destroys COMEX's credibility as a physical delivery mechanism. All three of those outcomes are bullish for physical silver, even if they manifest through different mechanisms. Let me be very clear about what I am not saying. I am not saying war with Iran is certain. I am not saying silver is guaranteed to move higher from here. I am not saying you should make investment decisions based solely on geopolitical headlines that could resolve peacefully within days. What I am saying is that the 75% probability Bob McNally cited, combined with the documented military buildup, combined with the within days timeline from Axios, combined with the COMEX delivery pressure that already existed before any of this Iran news broke, creates a setup where the asymmetry heavily favors being positioned in physical silver and accepting some volatility over being out of silver and potentially missing a move that has both geopolitical and structural delivery components driving it simultaneously. The falling knife narrative that was being deployed as recently as yesterday is harder to sustain when oil just moved 4% in a session on war risk and silver jumped in the same session. The speculative blow-off narrative that the Treasury Secretary deployed 2 weeks ago is harder to sustain when gold just made a record weekly close. The meme trade narrative is harder to sustain when industrial users are accelerating hedging and Samsung is signing exclusive 2-year mining offtake agreements. Every bearish label that has been applied to silver over the last 3 weeks was applied in an environment where war risk was background noise. War risk is no longer background noise. It is foreground. It is quantified at 75% by a credible analyst. It is being reflected in oil markets, precious metals markets, and equity market sector rotations into defense and energy. 11 days to first notice day, 75% probability of strikes within days to weeks, 2 carriers, 12 warships, hundreds of jets, 150 cargo flights already completed, Shanghai reopening February 23rd, oil above 64 and climbing, silver jumping on the news, gold at record weekly close. The narrative and the data are both saying the same thing for the first time in 3 weeks. The paper market tried to reprice silver lower. The physical market and the geopolitical reality are repricing it higher. One of them will be right, the other will be a trap. History suggests that when paper and physical disagree, physical wins. The timing suggests that the resolution happens soon.